Thanks for joining the Deal and EY's 2017 webcast, Sector M&A Outlook for 2017. I'm Rhonda Schaffler, anchor at The Deal. In the current slow growth environment, companies have been looking to help create opportunities to transform their businesses through deal-making, joint ventures, and alliances. 2017 will likely bring more transformational deals as 75% of U.S. executives plan to complete a deal in the next 12 months, according to EY's U.S. Capital Confidence Barometer survey. Companies are likely to explore inorganic opportunities for growth drivers this year, but not through a proliferation of mega deals. Most of the deals in 2017 will be under $1 billion, according to EY's survey. Meantime, executives project the valuation gap will widen in the new year. How can companies use deals and alliances to stay relevant in today's economy? What do deal makers and executives need to support successful execution and transformative impact? How will deal makers see these transactions through with increasing valuation gaps? What role will JVs and partnerships play? Joining me to talk about all of this and a whole lot more is Ben Edmonds. He's managing partner and co-founder, Consonance Capital Partners. David Gale, partner, Transaction Advisory Services, EY, and Aileen Stockberger, Worldwide Vice President, Business Development at Johnson & Johnson. We'd like everyone watching to be a part of today's deal-making conversation. Please submit your questions just to the right of your browser. Now we're going to get started. Let me welcome you all. It's great to have you for what will be a great conversation. Thank you.
Thank you.
Nice to be here.
So David, I want to start with you, and we'll start broadly with the overall outlook from your vantage point. Tell us a little bit about your expertise, how you see the year unfolding, and what nuggets of wisdom can we draw from that confidence survey that I made reference to at the open.
Well, thank you, Rhonda. It's a pleasure to be here today, and I think 2017 is going to be a very interesting year for M&A. I lead our Americas Industrials practice for our Transaction Advisory Services business, but more broadly than that, I think I'd like to start with a survey that you already referenced and our firm does, the Capital Confidence Barometer, and just point to, in addition to the 75% statistic that you threw out in terms of U.S. executives expecting to do a deal in the next 12 months, two things really. That figure is about 60% of global executives, and also most companies do have more deals in the pipeline as well. So obviously there's a little bit of a lull around the election that we've seen out in the marketplace. However, in times like this, I always like to look back at the fundamentals that drive the M&A business. So when you think about the level of cash, both on corporate balance sheets, private equity fundraising and dry powder, the shape of the credit markets, confidence, and corporate earnings, I think those all point to a strong year for M&A.
And David, just briefly, how different was the survey this year compared to the prior year in terms of some of the numbers?
So I would say we saw an uptick in terms of the favorability of the results. I think that the 75% and the 57% percentages were not the high water mark, but very close to the high water mark. So we're seeing a lot of confidence out there. I think it was about 75% of corporate executives view the economy as improving, which is another really favorable fact that will drive M&A.
Aileen, let me turn to you. You're one of the people that will likely be making these deals this year if history serves as a guide. What do you see from your vantage point? And if you could explain a little bit about your role at J&J.
Sure, and thanks for having me here today. So I've been with J&J over 25 years, and most of that time have been in our business development function. So I've been doing M&A for quite a long time. So because of that, I take a pretty long-term view of the M&A marketplace. So I do believe that 2017 is going to continue to be a good year for deals. And the reason I believe that is because deal making is all about long-term strategy. So anytime you do a deal, you need to start with strategy. Your strategy needs to be sound. And companies, while they're doing their strategic planning, should always be thinking about how to transform themselves, where they want to be. And one way is through internal means, of course, and the other way is through external means, through deals. So I think there's always going to be the need for deals. So to me, M&A is all about innovation and growth and transforming a company. So I think from that standpoint, 2017 will continue to be a good year.
Ben, you're turned away in, and tell me about your firm as well.
Sure, I'll start with that. First of all, thanks for having me here. So Constance Capital Partners, a healthcare-focused private equity firm. We also have a healthcare-focused hedge fund. Constance Capital Partners has 2 different investment vehicles. I spend all my time on the private equity side, Constance Capital Partners. I would agree with everything that David and Aileen said about the long-term trends in M&A. Clearly, there's been the forces of technology, globalization, and so on and so forth. I think also it's important to point out in terms of the last few years, there's been another accelerating factor, and that's the fact that we went through a pretty big crucible with the financial crisis in 2007, 2008, and into 2009. And I think what happened there, and that's really started to manifest itself over the last couple of years, is companies made it through there and built fortress balance sheets and had capital structures that were there set up where they could incur more debt. And when you have a situation where the economy starts to improve and you have under-levered balance sheets, the accretion dilution analysis is pretty compelling. Almost any deal you can do when you're paying for debt when you have an under-levered balance sheet. So that drove a lot of the growth over the last couple of years. In terms of the overall healthcare M&A market, where we spend all of our time, it's seen really significant activity. I think I've been investing in healthcare for about 25 years now. I would say the last couple of years has been probably one of the most interesting times to be in healthcare. You've had incredible amounts of change, not just technology and innovation from a drug and product standpoint, but you have a lot of changes in terms of what's going on in the market. And a big catalyst for change, of course, was the Affordable Care Act that was put in place with the Obama administration, which created a major catalyst for M&A activity. And I can talk a little bit more detail about that. So in terms of 17, I would say I really don't know what's going to happen. Obviously, one of the many executive orders that have been put forth is the repeal of that act, so I think there's going to be a pause in healthcare. I think there will be an acceleration once there's clarity, because there's a lot of drivers driving M&A in healthcare. But I think there's going to be a little bit of pause until there's some more clarity in terms of what happens from a regulatory standpoint.
Makes sense, of course.
Yeah.
Let's just step back a little bit on fundamentals. We're talking about cash on the balance sheet. The credit environment's still pretty favorable. I mean, even if rates go up a little bit, there's not an issue with credit at any side of the game, I don't think, is there?
We are still seeing terms that are very attractive. We typically under-lever our transactions, but we're typically offered terms that we don't take. But the average multiples for leveraged buyout transactions in the private equity world are back up towards almost pre-crisis levels, kind of 5.5, 6 times. So you're kind of looking at terms where you have 4 turns of senior, 2 terms of sub-debt. So very robust. Interest rates, very attractive. We started to see a little bit of dislocation, still pretty attractive. But also importantly, terms are very favorable. So you still have some cov-lite transactions happening. So overall, debt markets are continuing to drive M&A. And I think that'll continue into 17 for sure.
You know, I've asked this question before, but do you see any reason that covenant light would change going forward? I mean, what would cause that to become covenant heavy?
Someone has to lose a lot of money. So unless defaults change dramatically, and I don't see that happening, I think that'll continue to be the play. And then the other driver, it's really supply-demand dynamic, right? If there's plenty of supply of debt, the users or the demand for that debt will be able to drive terms. If there's a shift in terms of fund flows into credit funds, you'll see some pushback.
David, what else are you seeing in kind of the big macro sense for 2017?
Well, as I led with, I think that corporate balance sheets are extremely strong. We talked about the credit markets already. I would say that some of my colleagues in the private equity arena would say that there's been a little bit of very, very modest tightening in the credit markets as of recent. However, to your point, Ben, which I totally agree with, is when you look at it over the history, we are still in very, very good shape as it relates to credit. Earnings season is always telling, and I think we've been going through some good corporate earnings. Obviously, that changes day by day. I think that can help drive M&A, especially to the extent that the equities are being used as a currency to fund transactions. So, the big piece when you think about all the different C's they call them that drive the M&A market really is the confidence piece. And we all know there's a lot going on in the geopolitical environment. And, I think that has the potential to impact M&A. And I think we saw that around the presidential election here in the U.S., and we have seen a little bit of a lull in M&A activity. However, it does appear that it's starting to come back. We've all been through a number of M&A cycles, and what I always fall back on is the fundamentals. And so with those fundamentals strong, companies have a need for growth. They have a need for profitable growth. It's an ever-changing environment. There's a convergence of different sectors coming together, and I think with all those dynamics and the fundamentals being where they are, we'll continue to see a strong year.
You're probably seeing a lot of convergence.
Yeah, I think so. But I think also, I come back to that. I think there's always, and I've been doing this for a number of years as well as my colleagues here, is that there's always noise in the system. And to me, I come back to, I think you want to take a long-term view, especially if you're doing a larger transaction. So I think so I don't know that some of the things that we're seeing are really going to, modify the amount of deal activity. I get that sometimes you may have some short-term situations that could inhibit you doing a deal, but I think people really take the long-term view and look at it, strategically, where do I want to go? And from that standpoint, I think the deal activity will continue.
Let's focus on size, because the survey actually did pull out, as I mentioned, less than $1 billion in terms of what most executives are thinking, and there are always exceptions, and we read them in the headlines rather regularly. What are your expectations in terms of deal size, and does the structure of the deal change if we're not seeing those mega deals?
Yeah, so I would think from a size perspective, and I'd be interested in my colleagues' views here as well, the survey would indicate, and my personal view is that we'll probably see in the $250 million to $1 billion range being the sweet spot of the volume of transactions in terms of deal value. Now, I do think that we'll continue to see some bigger deals as well, especially when you think about some of the potential for deregulation in the marketplace. And when you think about that sort of middle market transaction, the $250 to $1 billion, companies are looking to augment their portfolio. On the divestiture side, companies may be looking to generate cash or get back to the core, so to speak. And that, in connection with the plays on technology, are going to drive that middle market transaction.
What are you seeing in terms of middle market?
I agree with you, David. I would actually take the bottom end of your curve and lower it a little bit more. When you talk about just volume of deals, not necessarily dollar value, we see tremendous amount of activity in the lower middle market, sub 250. We had some very large mega deals in the healthcare market in 2015. Most of those were in the insurance sector, driven by what was going on with the Affordable Care Act and need for scale. And I can talk you through some of those drivers around those deals. There was also a lot of inversion deals that were tax-driven in 15. Clearly, I think people have pushed back on those inversion deals, and I don't think there's going to be many more driven purely for tax reasons, particularly in the new administration. And then for the mega deals in healthcare, you saw one of the major deals, the Aetna-Humana deal, get some scrutiny from the FTC. And there's another deal, Cigna Anthem, which is larger, which we'll be hearing about in the next couple of weeks. So I think that'll probably dampen some of the larger mega deals, but there'll still be deals of size. You have this dynamic in healthcare. There's a lot of different drivers of the different sectors, but the big deals in healthcare have really been driven by this epic battle between managed care, the HMOs, and the insurance companies. I'm sorry, and the hospital systems. So historically in healthcare, you had a dynamic where, the hospitals would raise rates, push them on to the commercial payers. The commercial payers then would put them onto the employers. And I think over the last 5, 6, 7, 10, maybe 10 years, you've had employers push back dramatically on the rising cost of healthcare. And so that has kind of forced a little bit of a standoff in that pricing war between the hospital systems and the managed care. And so they're trying to get bigger to win that battle, and the FTC has started to weigh in. They don't want any one of those players to get undue scale. They don't want the hospital systems to get too big because they're going to push price too much, and they don't want the managed care players to get too big. So you're starting to see some pushback in terms of those bigger deals. So we think a lot of the activity is going to be more in the lower middle market. And there's a lot of different drivers around that. If you want, I can talk about that in a bit.
Yeah, I think from a company standpoint, you're always going to have some of the mega deals, and I've had the opportunity to work on a couple of mega deals, but obviously a company can only do so many of those and so often, right? So I agree with you that the sweet spot is the sub-billion-dollar deals. Those are a great opportunity to pick up a new company, a new technology, a new competency. You can incubate and nurture those types of companies and really get growth out of them. So I think from a company standpoint, that is a good sweet spot that we're always looking for new opportunities.
Your point on new technology is a really good one. It makes me think of some of the more unique structures that we're starting to see in terms of joint ventures and alliances and things that sort of mitigate the risk of entry into either a new technology, as we're seeing with regard to sector convergence. We're going to see companies in their core going outside their core where they're not as comfortable. And so I think a joint venture, an alliance, and a partnership is a good way to mitigate that risk. Also, in terms of new entrants into emerging markets, China comes to mind for sure, but there are many others in terms of getting acclimated to the current geographic region and the political structure and the way deals get done and business gets done in some of those more unique emerging markets.
How much is technology the driver in your sector, industrials?
So, well, first off, I would point to President Trump's indication that industrials are going to be a very heavy focus here domestically. In terms of technology, I think it runs the gamut. I think that there are definitely some companies out there that are leading edge in terms of their technology businesses, their digital businesses. There are others that are lagging more behind, but one thing is for sure, the industrials business is changing, and it is going to need to become more technological, and I think that's going to drive M&A here in the near term and the farther term.
At what stage are we in terms of that as a driver? In other words, early innings or midway through the game?
Probably somewhere in the second or third inning, I would say, Rhonda. I think that there's some companies out there that you've probably read about in the press that are definitely shaking things up, but there are others that are much slower to join the game, and there are others that frankly haven't started. So yeah, I think there's going to be a lot of activity to come.
For you, technology still as much of a driver?
Yeah, technology definitely a driver, but depending upon where we're talking about. So I think technology in terms of getting new competencies and what it means for us and what it means in the marketplace. Great opportunity for us to work with partners, as you mentioned, when there's areas that aren't our expertise. And then the other piece, I would say, is maybe innovation. So a slightly different take on it, but we're always out there looking for new innovation. To your point, new types of deals are being done with innovation, new expectations, different expectations on deals, on values, on premiums than what we had seen in our core businesses, in the last couple decades in terms of doing deals.
Okay, explain that a little bit further when you say new expectations.
So I think, I think, years ago, we were more likely to do deals in our core area of expertise, pick up products that we understood, very much in line with our current businesses. I think deal expectations in terms of pricing was similar to what we were used to. I think integrations, more tuck-ins, integrated into our business. I think today you see companies are looking for new capabilities, new competencies in areas they're completely unfamiliar with. And so it's changed a lot of how we do a deal. It's changed how we look at a due diligence, because all of a sudden now we need to do that very differently. We need different people who have different expertise that we don't have, so we have to look at outside consultants to help us understand the expertise, do an appropriate due diligence. Integration can be much more complex and diverse. The workforce, you might need to think of new ways to keep that workforce engaged in your business. They're used to different expectations. So I think there's a lot of moving pieces out there, and as we move outside of our core business, we need to be more flexible, and a lot of the things we're doing need to change.
So what are you seeing, Ben, then? Because a lot of the deals you mentioned, it's insurance and insurance, so it's less apples and oranges, I guess. Or are you seeing that as well?
You're seeing technology as a driver?
Yeah.
Listen, it's hard to look at any portion of our economy and say that technology isn't a major driver.
Yeah.
It's driving everything from the automobile industry with driverless car. That's going to impact the real estate industry in terms of how they're thinking about they set up their infrastructure. I think technology in healthcare, we're probably in the first inning. We're still trying to figure out how to capture data and make it talk to each other. So I think that there's going to be consolidation in the healthcare IT sector, because right now all this data that we need to make the right decisions and to manage all this risk that now providers are going to be taking in this new payment system, they need to have aggregated data, and right now they're all in silos. So there's a lot of M&A activity trying to get that data into the same place. Now, you compare that to the financial services industry, they've had that data consolidated, standardized for decades. Mm-hmm. So we're way behind. So I think there's some catch-up to be done. But clearly, I think there's going to be some M&A around that. I think technology in the med tech and pharma sector, I think will be a key driver of M&A. I think, curious if Eileen has a reaction to this, but the day where you could rely on marketing to a physician and have their physician preference drive a decision is over. Those physicians now are employed by hospitals. Those hospitals are under massive cost pressures, so they want the cheapest device. So if you're not clinically differentiated, if you don't have that new technology, you're not going to get a spot in that supply closet. So we're seeing a lot of the larger companies try to buy that or develop internally some of that clinical innovation so they can really be differentiated and make sure that they have a spot on that formulary and get a spot in that supply closet.
Yeah, so Ben, no, I think you're right. I think, healthcare, right, it's all about getting to a better outcome for the patient,
exactly.
Right? And a better outcome for the healthcare system. So better products, cheaper, right, in the long run, better outcomes for the patient. And to your point that, there's always new advances. And I do think the reason why that's really important in M&A is because we recognize we're not going to come up with all that innovation internally. While we obviously spend billions of dollars on internal R&D, we recognize that we need to be spending quite a lot on external as well. And so we're always looking for new opportunities on the outside, and hence the M&A.
Which type of deal is harder integration-wise? For instance, you're doing a R&D internally. You see somebody that has something you want. Fairly easy to integrate, or are their methodologies, the way they're doing their business, a little different than what you're used to?
Yeah, so I don't think there's any integration that's easy.
Try to find one.
Yeah, but they're all unique, and I think that's the most important thing, is to understand the type of company. For instance, if we go out and we acquire a small company, there's a reason why people wanted to work in a startup and wanted to work in a small company environment, and then they find out they're going to be acquired by a company the likes of a Johnson & Johnson, right? Completely different environment. And that's where we need to understand that through integration, understand what that means to those folks, make sure we can nurture and maintain what part of that environment made them successful and why the employees really liked it and enjoyed it, and make sure that can still be fostered while them being a part of a larger entity. So I think it's really about understanding the uniquenesses of the integration in order to make it most successful.
One thing I would highlight there is the people factor. I think I agree with you 100%, Aileen, that there's no easy integration no matter what it is, but that people factor, I think, is something that can really make it a challenge. And the other factor in addition to that, where you could have a cultural misalignment or two different cultures that need to be coming together. That's, to me, sort of the first and foremost issue that would drive complexity. In addition to that, I would say that IT is another area that can get extremely complex.
How do you factor in the human side during due diligence?
That's become a real area of expertise, and I will go back to 20 years ago doing deals, I don't think we spent that much time on it. We certainly didn't spend enough time on it. Now this is a whole new area of expertise with experts that can come in and help you with assessing the culture, making sure the cultures will be able to mesh, how to preserve the jewels of each individual culture, and how to get the most out of it. So I think there's a lot more time spent understanding the cultures of the two companies, understanding the leaders, understanding the way business gets done, to ensure that you'll get the most out of your deal and out of your integration.
Because if some of that human capital starts walking away, all that work on a deal really is not going to get you the payoff that you want. It might look good on paper,
Yeah.
but then if it can't be executed to the level that everyone designed it.
Yeah. And we've seen not everyone is as good at integrating businesses as J&J, unless they're getting advice from EY. EY, sorry. But we've seen, and this creates an opportunity for us. You see young, innovative companies getting bought by large corporates, and all that energy that they had of beating the big gorilla in the space dissipates, and they lose the people, they lose the culture, and that creates an opportunity for us to go carve that business out and re-energize it, put the right people around it, put the right incentives. So it definitely creates opportunity. In terms of the importance of the human dynamic for us, we spend all of our time looking not only for great companies, but looking for great management teams. And there's a lot of elements of healthcare in particular that are commodity. One hospital versus another hospital, one imaging center versus another. You could say those are commodity businesses, but if you have the right management team that builds the right culture and focuses on who are my constituents, who am I serving, how do I execute on customer service, you can really differentiate yourself, and that's all about the senior management team and the culture that they build. So we spend a lot of our diligence process focusing on that piece.
Mm-hmm. You mentioned earlier, kind of speculating a little bit, what the next wave of M&A might look like in healthcare, and of course there are a lot of unknowns.
Sure.
We don't know what's going to happen, but how might whatever replaces Obamacare, assuming that it is repealed and there is a replacement, how might this process be different than the last one? And again, I'm throwing a lot of ifs out there because we don't have it on paper as to what's happening.
Well, I think there's a lot of, the Affordable Care Act clearly was a big change in terms of how the government was paying for certain things, but I view it really as a catalyst that created a galvanizing force where the industry had been sitting around talking about paying for quality, talking about shifting away from fee-for-service towards paying for value. We talked about it for 20 years, and care coordination and all these things. The Affordable Act kind of created a catalytic event where everyone started pushing in that direction. So there was massive amounts of M&A around that. Providers realized they weren't just getting a fee-for-service wheel. It wasn't an a la carte menu. They were going to get a bundled payment. So in that dynamic, all the providers were trying to there was a race for the first dollar. They wanted to get that bundled payment and hive it off to everybody else. So hospitals were getting into the ambulatory surgery center business. They were buying physician groups. They were on the front end. They were getting into urgent care to make sure that they controlled the patient as they came in. I think all that's going to continue. I think that all of that makes sense. It's the biggest fault line in healthcare is that you had people getting paid on volume, and then you had consumers who had someone else paying for it. But now I think the market's moving. I think there's going to be a little bit of a pause to make sure that we're not shifting towards something totally different. But once there's clarity, because I don't think when you listen to what the administration has said about what they like and don't like, there'll be some tweaks. My guess is it's not going to be that radically different. There's 20 million people that have insurance now, and I think it's going to be pretty tough to take that away politically. So I think all that's going to continue to drive a lot of M&A and change within the healthcare market. And I think it's exciting because we really need to make some of those changes. And we as investors, that's what we spend our time thinking about. How do we help the market evolve and create more innovative solutions?
Just a guess to all of you, which sector do you think is going to show the most activity this year? And David, you might be best for this. Again, we don't know, but could healthcare be the top sector for M&A? Is it technology? Is it industrial, where there's also all sorts of new issues facing industrial companies, the idea of onshoring, things like this?
Yeah, sure. It's a good question. I would refer back to the Capital Confidence Barometer. And that would indicate that consumer products and retail is going to be extremely hot, followed by diversified industrial products. I think technology will certainly be there, and then maybe a little bit of oil and gas would be where I would look. The big theme with retail and consumer is really around disruption, and we all see what's going on as consumers ourselves, and how that marketplace is changing, and how the brick and mortar businesses are going to become a thing of the past. And
well, maybe not all of them. They don't want to hear you say that. They're trying hard, right? We have Walmart just saying we're going to do free shipping. So it looks like they're trying very hard.
Yeah.
They might not have the answers yet.
Yeah, yeah, absolutely. Good point. And the theme, though, is that disruption is going to be there, and that the way that consumers have bought things in the past is not the way that they're going to buy things in the future. So I would, again, just to come back, I would look for consumer and diversified industrials and technology to lead the way.
It was interesting. I was just at a retail convention in New York, the National Retail Federation that has an annual conference. It was, you could have called it a tech show. We have this technology. We can track when somebody comes in, where they're looking in the store. I mean, it was really eye-opening, because if you're a retailer and you're in this environment that you describe, you have to think, what is perhaps the small acquisition I make that's going to give me that leg up? I don't know, it's very difficult.
Right.
Yeah, I think that's back to Ben's point earlier when you said that. I think technology, it's in everything that all of us are doing in all of the different sectors. So it's a changing world for all of us.
What else is a big driver in 2017, would you guys say?
I think for us in healthcare, it's the shift towards the consumer. There's been a massive trend towards consumerism in our industry. I think the day where you went to the doctor and took what he or she said as Bible and did what he or she said is gone. People are informed, they're online, they're digging in, they're doing research. They're involved in their healthcare, they're involved in their parents' healthcare, and they're involved in their children's healthcare for sure. I think you couple that with the massive shift in benefit design that I alluded to a couple minutes ago. There was a lot of talk a few years ago about the uninsured, right? We had these 52 million people that were uninsured. The rest of us, for the most part, were probably overinsured. We had our employer paying for healthcare insurance. We had no skin in the game. Our knee hurt. Our doctor said, go get an MRI. We had one 6 months ago. We'd go get another MRI. With the benefit design change going on, where now deductibles have gone up dramatically. I think the average deductible now is $2,200, $2,500. I might be a little bit dated on that. But the percentage of people who have a high deductible plan is increased dramatically. So all of us now think for a second, okay, do I really want to get that MRI? Maybe I should look at an alternative. Maybe I should get some PT. So a lot of the players in our space are thinking about, how do I engage that consumer? How do I get their trust? How do I communicate to them? And it's technology, digital, all that, social media. So that's a pretty big change. The day where you kind of went to the doctor and sat in the waiting office for 45 minutes and you just, you took your dose of medicine, that's gone. So I think there's going to be a big trend towards trying to engage that consumer.
Are you seeing that as well?
Yeah, no, I think so. I think that's correct, and I think that's why it's modifying. It's modifying what we as a company need to do and the types of things that we're looking for. So I think you're right. I think that's going to increase some of the deals that we do, where there are some solutions that are out there that probably aren't necessarily being created in-house. While we do some in-house, a lot of that we'll see on the outside with some of the ideas that people will come up with.
Are you spending more time and resources thinking about how you go direct to the consumer in terms of how you market your products and devices and therapies? Or is there a change in the last few years in terms of how you think
I
about
don't know
that?
that there's been that much of a change in the last few years in
That's
that.
because you were so cutting edge from...
Yeah, well, I'm not sure about that, but I think in terms of, to your point, I think the consumer is more educated. I think that's a trend that started a while ago, while people were able to, back when you started being able to go out onto WebMD and look up and figure out, self-diagnose and investigate your own health care some more. So I definitely think that's a trend that's continuing. Another piece I would say I think we're going to see continuing is divestitures. I think you're going to continue seeing large companies divesting parts of their portfolio, and I look at it as good portfolio management. Just like you're acquiring, you should be divesting. It's no different than you do with your own personal investment portfolio. You buy and sell as the times change, as your strategic focus changes. So I think we're going to continue. I think we'll continue seeing that as well.
Because that's a way to innovate as well.
Exactly.
When you look at other kinds of, whether it's a carve-out or does the divestiture, does one type seem more favorable than others in terms of?
My personal view is I think we'll continue to see more carve-outs, and I think it kind of relates to some of the themes that we've talked about and some of the things that Aileen just highlighted. I would say that when we think about carve-outs, one of the faults that we've sort of seen in the past is companies putting speed too high of a focus area in terms of the quality of the execution of the transaction. So word of the wise, I would say a lot of times we'll see to get a business ready for sale, it can take upwards of 6 to 12 months. That all depends on a number of different factors, but the size, the complexity, the global nature of the business, who the ultimate acquirer is going to be of that business, whether it's going to be a financial private equity acquirer or corporate organization, could drive the need for audited financial statements that tends to be an underappreciated part of the process in terms of time, but I've seen that become a gating item. So I think those are the things that I'd watch out for in terms of divestitures and just be ready for here, as I think that I agree with Aileen as they will be more prominent here.
Yeah, and I would agree. I think especially in the larger divestitures, I think they can't happen that quickly. It does take a lot of planning, and then I think it pays in the long run, but it does take time to pull together the complete package and be ready to and be ready to go out to the marketplace. So yeah, I would definitely agree. I think we a lot of times a company, once they make a decision, they probably would like to have it done quicker, but I think it's one of those things where it does take considerable. It takes patience. It takes some time.
We're also seeing a lot of increase in the level of sell-side due diligence, and that sell-side due diligence can take a number of different forms, but we're seeing it both in the corporate side and the private equity side, and it's also used a lot in auction processes, and it can really help to smooth out a process and not only improve the process overall, but increase the valuation, keep people's stress levels lower as they're going through the transaction and that type of thing.
Can I just
Sure,
add on? Yeah, you guys, I think you covered this. We definitely see more divestitures happening because whenever there's strategic M&A at the macro level, there's going to be little parts that fall off where I think when you kind of integrate a large business, then you step back and say, wait a second, I got 5 divisions, they're non-core, I'm 8th in this market, we don't have enough resources, it's not part of my major strategic vision, so there's going to be divestitures as a result of the overall M&A. We love that. We love buying divisions of large companies that have been under-resourced and unloved, and bringing in the right management teams and the right resources around it. I would also agree with you, David, that we're seeing a lot more sell-side diligence done. You're seeing, this is a dynamic that's occurred over the last few years where there's Q of E reports done by the advisor, the sell-side advisor, so that everyone in the process doesn't have to go do their own quality of earnings review. It's kind of done and put in a package that it's, so they're trying to neaten up and put it in a bow and make it easier to transact. So we've definitely seen that dynamic occur.
Yeah, and the one footnote that I would add on to what you're saying is that I don't think that because there is sell-side due diligence that it's necessarily an opportunity to avoid doing buy-side due diligence. I think it's always always required. Now, you may, to your point, Ben, be able to lighten up on that and use your own diligence team to figure out the quality of what you're looking at, the level that the accounting firm has put on it, and really use that as an opportunity to get smart on the business quicker, but not use it as a free pass to go do a deal and say that someone else did the due diligence.
I want to switch gears for a moment because we actually have a question about cross-border M&A, and that's somewhere I wanted to go next. So perfect timing. And I know, Aileen, you have some thoughts on China in particular. So
yeah, so
please share.
I think in general, I think cross-border M&A is going to continue to be strong. I think companies are becoming more global, and so I think you are going to continue seeing a lot of cross-border M&A. I spent quite a bit of time working on deals in China. Yeah, definitely had some lessons learned. I think it's certainly an area where you need to have an open mind, and you need to have patience when you're going into a different country and a different culture. I had an experience a number of years ago where we were actually acquired a state-owned entity. And that deal, in terms of timelines for doing deals, certainly maxed out for me. That it took us 5 years from beginning to end. So I come back to patience. You really need to have patience. Why did it take so long? Part of it was new for the Chinese government at the time to be looking at selling a state-owned entity. So they were learning along the way. We were learning. It gets very complicated when all of your documents are in local language. Much less likely to have what we're all used to today in all our deals, the electronic data room. We're back to talking about going in a room and looking at boxes of documents. So that took a bit more time. And it took us a little bit of time to figure out how to deal in that situation. So another one of the tips I would give that we did that worked well was I had a parallel team. So I had a team in China who were our employees working in our businesses in China, but they had never done a deal or a due diligence before. But they could go through the local documents and understood the local language, obviously. And then what we had is I had them paired with people mainly in the U.S., but experienced deal people in their specific area, so a quality person matched with a quality person who could help train them how to do diligence so they knew what they were looking for. Someone they could explain their findings to and discuss in their area of expertise. So that worked really well. But it takes a little bit longer. It takes more time. So I think it's patience and flexibility. I think if you go in assuming that you're going to do a deal exactly the way you would do a deal in the U.S. in another country, I think that's a bit naive. I think you need to be open to different ideas and different approaches.
Yeah, I think that was extremely well covered. I do have to say, Aileen, I think 5 years is the record that I've heard.
And we were working with EY on that deal, so thank you for your help. But it was.
Patience is a euphemistic term there.
Exactly.
For sure.
And the cultural aspects, I think, can sometimes be underappreciated, and I think that they're so paramount. In fact, I believe the phrase due diligence is something you don't want to say in China, right? Because it has a specific connotation that they don't like. And so when you think about deals in China, obviously they take longer, whether it's China or another emerging market. I would say tax is a key issue that needs to be understood. Brazil comes to mind. They have a great number of different taxes that need to be understood, and they can really drive the deal, fortunately or unfortunately. Going back to China for a second, and I don't mean this at all in a critical way, but one of the first things that needs to be understood is, how many sets of books are there, and what is the right set of books to base my valuation on? And that is where I agree with you that that local piece is really paramount
Right.
to really understand those types of factors.
Ben, do you see any issues in terms of cross-border cooling off a little bit as we have a political environment that might be changing, even talk of a border tax depending on?
Yeah, we don't do much cross-border, so I can't really comment on that, though we have talked as a firm that might be a fallout. I don't think so. I think, listen, the trend towards globalization is massive. The trend towards efficiency and the drive for efficiency, I think, will override that. There might be a temporary blip as people think about tax shift and repatriation
And say for currencies, I guess
and
currency swings.
currency, right? When
temporary
interest rates move around, you can do great on an operating bet, but then your currency goes against you. And I spent a bunch of time in the late '90s in Brazil, trying to do deals down there. And the dynamic we saw from the private equity side was they wanted U.S. valuations. There was at that time, developing country risk. You had a lot of them, when you did diligence, not covering all those boxes from a tax perspective. And obviously you can't leverage those assets like you can U.S. assets. And then you had the currency risk. So we found the risk return was difficult. When we did it, we found it very, very important to have, to your point, Aileen, about having people local. And so we tried to partner with local partners down there when we did deals in countries where we hadn't been operating for a long time.
Yeah, I think that's actually another good point. In terms of getting into a new geography is another opportunity for partnering with someone or doing a joint venture.
Right.
So, for instance, I think that's a great way to get into a country if you don't have that expertise. Once again, Johnson & Johnson is a large company. Back to an example of China, we have a large local presence, so we're in, that's easy for us to actually acquire. But if you're new to the country, I think that's a great opportunity to get in and partner with someone local. Yeah, less risky. Learn from them, learn together.
So we actually have another viewer question I want to get to. It's a good one. How do each of you think about successful integration of acquisitions? So let's define success, and I'll start with you on that.
Wow, okay, that's a good question. So when we go in and we are looking at doing an acquisition, we look at our value drivers and we determine what are the value drivers. So what are the reasons why we're doing the deal, and what are the aspects where we want to ensure that we can create good value for the company, for the shareholders. So I think a successful integration is where you can actually tick off and say that we've tackled the value drivers, that we have met our goals and objectives in those areas, or we're on the path and we have plans in place to meet those goals and objectives.
David, what do you tell your clients?
So I think that it's definitely a good question, and I agree with you on the strategy component. The one footnote I would put on the strategy component is what we talked about earlier in terms of cultural fit. I think that's going to be paramount. And then I come to a best practice really is integration in the due diligence process. So oftentimes we'll see the integration get pushed off for later because we're focused on doing the deal execution. And I don't think that is the way to handle it. I think that integration due diligence needs to be handled up front, and then the synergies need to be identified. And I think that the planning process, these integrations, they can't drag on forever, or it's probably not going to be successful. So setting a goal to be done with that integration within 12 to 18 months, I think is good. Before that, a 100-day plan, and making sure that you're executing against a 100-day plan, and really making sure that you have the right structure around the integration in terms of the management office and the people that are going to do the work, whether it's outside consultants or internal. People have day jobs, so making sure that it's realistic that this is going to get done, because the integration really will transcend the company.
Ben?
So was the question around how do you execute on a successful integration, and
how
what
do you
defines
define a successful integration?
Okay, two different questions. Okay.
But you can tell us about executing, because I'm sure
I
people
think
want to hear that too.
I think execution, to your point, David, it's all about communication, right? And I think it's the diligence and making sure you're assessing realistically, do I have the resources to do this? And making sure if you don't, you supplement that with inside or outside resources, and then communicating that plan throughout the organization. Because to me, the definition of a successful integration is not only did you get the earnings growth, but did you end up with all the capabilities that you tried to acquire? A successful integration that just gets the earnings growth, the synergies, that might work from the near term, but long term, you won't get what you paid for. Because really what you're buying is a core set of capabilities and skills, and if you don't maintain those capabilities, it's not worth it. Maybe you get a blip from some synergies. So I think making sure you're communicating and making sure that people feel empowered and they understand where the combined company wants to go is probably the most important. And if you end up with people staying and excited about the vision, that's a successful integration.
When is it time to back away from getting the deal done? I think in the case of technology, you have a 5-year deal in China. Have you ever been in a situation where it's taking a while for a deal to get done? Maybe the technology is not exactly what's needed anymore. Is there an example of that? Or is there, what's the trigger in the process or with the management or with the investor where suddenly it's like, you know, it looked like it was a good deal to pursue, but now this tells me that we should maybe step away and look elsewhere?
I think that's actually a really good question. So I'll come back with a caveat on my China deal. It was a consumer product that had been in the market for decades and will continue to be in the market for decades. So, and I thought about that myself because after a while after that I moved into medical devices. And in medical devices, I don't know that you would have hung in there for that long because you potentially could have lost the value in the meantime, or more competitors come in and not have something that has such a longevity of life in the marketplace. So I do think that's really important. What's the point? I guess it's a little difficult to tell, but we're in a very fast-paced technology environment, and so I do think it's important to think of unique ways to sometimes get deals done quicker or quick enough that they still make sense. And after a certain period of time, I think deals do start having an expiration date when they're just not as valuable.
And I would say keeping the emotions out of the deal, you know, very, very key. And we've seen
Tough to do.
seen executives get married to deals, and they're going to do it, and you know the price, relative price anyway, keeps going up, and we'll just do it anyway. And I think that's why not every transaction ends up being successful. And so from that context, I would say making sure that you have the right eyes, a good experienced leadership team, a diverse leadership team that can really you know, stay focused on, is this the right strategy for my business?
I think it's a great question. We ask ourselves that question all the time. You know, we're in the business of trying to get transactions done and build companies. I think if you asked us that question 15 years ago, we would have said, if a deal drags on, time to let it go. But I think in this market, you really need to be persistent and perseverant. A number of our deals have taken well over 2.5 years to get done. We are trying to create proprietary transactions, trying to buy things that aren't necessarily for sale. So it takes a while to develop the structure and the transaction. I think the time to walk away is when you realize your original thesis was wrong.
That's right.
You know, if the thesis is still intact, you can get through personality differences, you can get through differences in performance and structure around things. You can always be creative, get a deal. But if you're wrong on that thesis and you're just clinging on to it to keep the day alive, you should just let it go.
It's hard though, right? Because people stake their reputations and they have people buy into the idea. So it's hard. That's human nature. It's hard to backtrack.
It is hard, particularly when you've invested 2 years or
And
5
money.
years for that
Right.
matter.
That's
Yeah, there's an escalation of commitment.
Okay, another question for all of you. Can anybody think of a time where you got a deal done, there were synergies, they were even better than expected? There was kind of like an added layer of something that made that deal even more valuable. And if so, what was that?
It never happens.
Rarely happens. It does happen, but it's rare.
I think probably where you get that is, back to a comment Ben made a few minutes ago, is about the people. I think if you get the right people and if you get creative, innovative people, they can really, that can really blossom and turn into so many different things that you never even imagined when you were doing the deal. So I think it's about the right people, nurturing them, retaining them, making sure it's an environment that they're excited about and they want to work in. And I think that's when you can really hit a home run in a deal.
I totally agree.
I agree with that as well. And then I would just add, a lot of times what will make deals to be even a bigger success than they were planned for is really the timing. And some of the things we've talked about in terms of unknowns today will be out there. I can think of one deal where we were on the sell side and this business was really focused on the housing market. And you know, this deal was right before the kaboom in that marketplace. And so, you know, whether you're the buyer or the seller, that's going to be a difference. But that was the thing that really made that deal a big loser for one and a big winner for the other.
Mm-hmm.
Is there one big macro risk to deal making in 2017, or is it more a sector story of risk?
I think the big macro risk really is the geopolitical environment and what happens there. But again, I would always come back, and I've been doing this for a lot of years. I would always come back to the fundamentals over some of the newscasts that we're seeing out there in terms of the geopolitical ramifications.
And you don't see anything with the fundamentals we talked about early on about feeling good about the economy, fortress balance sheets. I don't see any reason that will change. There's no risk to that.
Well, I'll never say the words no risk.
Low level of risk for that.
Yeah, I think the fundamentals are in really good shape, and I think we're going to work our way through this just fine. There's always uncertainty on the horizon, and I think that with it's not just one fundamental that's good or half of the fundamentals are good. They're all pointing relatively good, as we've talked about throughout this discussion. So I think with that the temporary lull that we may have seen around the election will be temporary, and it's just a matter of when, because companies are going to need to continue to strive for profitable growth and be strategic and add technology and all the things we've talked about.
Yeah, the only macro event that I think would be a collapse of the credit markets, and I don't see any structural over leverage in that market that would suggest that we're going to have a similar pushback. It seems healthy. There's good support of that. So I think it's going to be more sector specific, and I think the risk in the sectors are going to be driven by unforeseen consequences of legislative action. I don't think this is an administration that's going to look to regulate and add regulation, but immigration reform has repercussions on other industries. Can technology companies get staffing if you change around how the immigration laws work? Healthcare clearly is going to be. We're all sitting around waiting to see what happens with some of this change. So I think it's going to be more sector specific. I don't think there's going to be a macro risk.
Which is good.
Yeah.
And you're not even waiting around. You have those incubators now, J&J.
Yeah. So I think. Actually, so in J&J, one of the things we've started in the last 5 years, we started J&J Innovation, and it was a way of making sure we got to more early stage technology. It's been extremely successful. So we started innovation centers around the world in London, Boston, California, and Shanghai, and wanting to make sure that we had people on the ground looking for early stage innovation in the hotbed areas of innovation. We also have J Labs, which is incubators, as you mentioned, and actually opening a new one in New York City in 2018, I believe. But we have that in California and Texas and Toronto as well. So we're always looking for ways of making sure we're seeing the innovation early, knowing what's new, what's going on, in the marketplace, in the environment, to try to get ahead of the game whenever possible.
Very interesting. Well, we've covered a lot of ground here. We have a couple minutes. I want you all to give a closing thought about anything we discussed, anything else you're looking ahead to for 2017. And Ben, I'll start with you.
First of all, I thought this was a great conversation, so thanks for
Good job to all of you guys.
great questions and thoughtful comments from my colleagues here. I think the one closing remark I would make is that we're just incredibly excited about what's going on in healthcare, and we spend all of our time thinking about how to invest in ways to solve the problem we have. We have this problem where the healthcare is going up towards 20% of our GDP. There's a lot of great things that are driving that in terms of innovation, but we really can't sustain that, and we try to pride ourselves on looking at ways to help solve that problem by looking for innovation and cost efficiency and so on and so forth. So we're excited about the prospects going forward, and we think it's going to be an interesting couple of years to be investing in the space.
David?
Thanks, Rhonda, and thank you again, Aileen and Ben. It's been a great conversation. One of the things that I've really enjoyed is it feels like we're relatively in sync. And I've sat in these discussions before where there's a lot more banter and, how is 17 going to be good if X, Y, and Z? And this one is good. Now, we could all be wrong. But again, I fall back on the fundamentals. They're all in good shape. So I'm looking forward to a good, strong year in 17 for M&A.
And Aileen?
Yeah, so thank you, and as well, happy to join you all in the conversation. So I think 2017 will continue to be a great year. To me, M&A, it's all about innovation and about growth. I've been doing this a long time because I love it and I think it's exciting. I think it's going to continue to be exciting. I think companies are always looking for growth, always looking for innovation, and I think that just means the deal environment's going to continue to be strong.
Well, my thanks to all of you, and we want to formally say thanks to Aileen Stockberger, Worldwide Vice President Business Development at Johnson & Johnson, David Gale, Partner Transaction Advisory Services at EY, and Ben Edmonds, Managing Partner and Co-founder, Consonance Capital Partners. Thank you so much for watching. I'm Rhonda Schaffler with The Deal.